And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Of course, Danny Ratliff joining me this morning. We're going to be talking about some of the latest money moves by Suze Orman. Just let that percolate with you for a minute. Kind of like a hot cup of coffee this early in the morning. Actually, this morning, I've discovered something new in my house, which is my wife drinks a cup of sleepy time tea just before bed, right? So it's just tea to make you sleep a little bit better. And then she combines that with a dose of Jack Daniels and NyQuil. But, no, I'm joking. But I discovered last night that you don't let her put the coffee pot on after she drinks her tea, because somehow the coffee pot didn't make it all the way into the coffee maker. So this morning I'm cleaning up, coffee all over the floor this morning at 3:30 in the morning. Not the best way to start your mornings, but anyway, yeah. So it's just those little things, right? It could be worse. Could be worse. Anyway, market really didn't do a whole lot yesterday. A lot of chopping around overall, and really just starting to really kind of struggle here a bit. And again, we've kind of talked about this before. Markets are very overbought on a short-term basis, and that's just going to limit upside here near term. We're going to kind of go through all the markets this morning, just kind of look at what's been happening with money over the last couple of years in particular, in a variety of markets, just to kind of see where things are working and not working. But we'll go through those this morning in our morning market update. But overall, we're now moving further into the month of February here. And, economic data has been good. And I thought it's interesting because if you take a look at the economic data on the headline, right, and you just look at, what does these headlines numbers say, right? So, good unemployment, very low employment, jobs high. It seems to be everything is doing just fine. But yet, and again, we've talked about this real dichotomy between these numbers that we get from the government and then what we know is kind of boots on the ground of what's happening in the rest of the economy. Consumer delinquencies on credit cards are rising pretty sharply. We're now moving up into areas that we haven't seen since 2008. Now, I'm not saying a financial crisis is coming, so don't go jump off a cliff. But I'm just saying we haven't seen this high of a level of credit card delinquencies, and particularly for 18 to 30-year-olds. It's a much bigger jump in that area. Not surprising. They have more debt and less revenue coming in terms of income because they haven't matured in their jobs yet. But we're seeing a very big increase, not only just in credit card loans, but also auto loans. So what's that telling us, of course, is that if they're becoming delinquent on these debts, that means they're running out of money. And this certainly doesn't bode well for a booming, strong economic economy. At the same time, we have a very rapid drop in the number of workers that we're actually have working in the workforce, right? So our if you take a look at labor force participation rates, those are, low relative to where they were back, say, in the 90s. And so we've got a less, there's basically 100 million people that don't show up in our labor force participation. They're out there somewhere, right? And we make the excuse, well, they're retired or they're at home taking care of kids or whatever it is. They're students. It's 100 million. It's a third of the economy. So, it certainly suggests that underneath the surface that things aren't as robust as they may seem on headlines. And of course, this is why you see so much angst about this upcoming election, and it's this need for change is really kind of starting to percolate, kind of through the headlines, is that more and more people are wanting something different. They need something better because what they have is not working for them, and so they're looking for a different opportunity. But again, when you step outside of that and kind of just focus on the stock market, sitting here right at all-time highs, and we're talking about hitting 5,000 on the index just in the next few days, everything seems to be okay on the surface. But again, as we've talked about before, that's a very small percentage of the population that actually participates in the markets. The rest of the economy's not doing so great. So, we'll see how this plays out for the rest of this year, but watch delinquencies, because delinquencies are a good leading indicator of economic activity, because obviously consumers make up 70% of the economy. Now, doesn't mean anything. It doesn't mean a recession tomorrow. It doesn't mean market's about to fall apart. Doesn't mean anything, but it's worth paying attention to. It's just a very different message than what we're getting kind of from these headline economic numbers. So, all right, but real quick, before Danny joins us this morning, let's go through some markets. I thought this was kind of interesting because we see a lot of data coming out. It's like, oh, valuations are cheap in international markets. Valuations are so cheap in emerging markets. Or, the valuations in small cap, mid caps, relative large caps so cheap. Maybe. But, where's been performance? So let's look back over the last 3 years, right? So let's go back 3 years and look at what markets have done over the last 3 years. So this is the S&P going back for 3 years. It's hitting all-time highs, right? So, we've recovered. We had a peak back in 2022, went through 22, 23, have now recovered all that. So we spent about 2 years going nowhere, but it's actually performing better. Again, overbought a lot of things. But, real performance, of course, has been in the NASDAQ, because the NASDAQ is what's been driven by all these technology stocks. Obviously, a much bigger advance to new highs coming out of that decline that it had back in 2022. But, again, making money here. So, again, over the last 2 years, the S&P and the NASDAQ, you've made some money on a buy and hold basis. Not a lot, but you've made some on a buy and hold basis. This is where it starts to get interesting, because once we start looking at, say, the small cap, mid cap index, the Russell 2000. Here was your peak in January of 2022. This index is still in a bear market. So again, has not done anything on that small and mid cap basis. Does it mean it never will again? No, I'm not saying that at all. But if you've been invested in small and mid cap stocks, you've drastically underperformed that of the S&P and the NASDAQ. And we can actually drill down. You take a look at emerging markets, right? So this is an industrialized emerging markets. Industrialized international markets. My apologies. Not as bad as small cap, mid cap. Has recovered somewhat, but still below the 2022 high. So you're still have not made money in the international stocks over the last really 3 years. Same thing for emerging markets, actually probably the worst performing of all these indexes. Over the last 3 years, you were in a deep, deep bear market in emerging markets. Absolutely been a horrible place to be owning international emerging market stocks. So again, when we start looking at, the bulk of this, just look at pure small cap stocks. This is a small cap 600 index. Again, not really making a lot of progress in the small cap areas. So, and this has been some of the issues about performance. Here's gold as an example. Gold's actually holding up here, but it hasn't really done much over the last 3 years, right? So you haven't really made money, haven't really lost money, but, gold as a commodity has not been really tracking on a performance basis. So here's the thing about this. Look, we look at the earnings. We've talked about this earnings issue that's going on right now. And if you take a look at earnings are being driven by one sector of the entire market. This was part of our analysis that we went through yesterday here on the show, showing the big bifurcation between NASDAQ stocks and every other index and market that is available. So again, when we start looking at these long-term correlations, they're not holding up. And more importantly, as an investor, if you're trying to run, I got an email yesterday saying, I'm looking to build a diversified portfolio of all these different, type of markets. That hasn't worked. And, this is one of those markets that we're in where there's a very narrow group of stocks that are making money. The vast majority are not. And that makes it really challenging to manage a portfolio. So anyway, that's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff and what Suze Orman is saying for you to do with your money now. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit. Communicate about your money. and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratcliffe will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Danny sent me over this link this morning. I'm surprised he's here. He was hanging out at the bar with Larry Fink last night.
I was not at the bar. And I was out of there at 8.
That's late for me.
That's late for me.
You remember the days when you used to go out and party till like 2 or 3 in the morning and you'd get up and go to work the next day? It was like no big deal.
Yeah, like 30 years ago.
Yeah. Yeah.
Now we're getting up at that time.
I know. You know, my whole day is like, man, I can't wait to get to 8 just so I can go to bed.
Oh, man.
Anyway, so what's Suze Orman got to tell me now that is the smartest? Because, I mean, nothing she ever says is right. So I got to know this one. What's the smartest money move I can make right now? And it means I can get a guaranteed earnings of 5%. This has got to be great.
It's earth-shattering.
It's earth-shattering, I am sure.
Well, you know, we're seeing more and more of this, especially with the thoughts that the Fed is going to reduce rates here at some point this year. And so, obviously, this is no new news to probably most of you guys out there. But go buy a 1 to 2 year CD. It's exactly what she's telling people.
So I've made 3% in January, just being in the market.
Yeah.
Actually, 4% being in the S&P. If I just bought the S&P, I'd be at 4%. That's a 48% annualized return versus 5% in a CD. Why would I do that?
That's assuming that's going to continue, right? I mean,
we did but we did 22% last year.
Well,
in the
hold
S&P.
on. Yeah, but most people didn't achieve
Well,
that.
I know that.
And I think that's so it's interesting. You know, you mentioned Larry Fink. So had dinner last night with a small group of people, and Larry Fink and some of his board was there. And really interesting, just kind of shedding light on, like, you know, big picture items and things like this. And that was actually a topic they brought up that, you know, and you and I have had these conversations. You've written about this vigorously about money on the sidelines.
Right.
And, you know, his concern, he says, listen, I don't think people are moving from, if you get 5% in cash right now, there's so many things out there that people are concerned with. He's like, I don't see this mass inflow of funds towards the equity market. He's like, it's not necessarily the inflow of it. It's just the momentum of people putting funds to work and buying things and pushing asset prices up. Because as you always note, there's a buyer, there's a seller.
Right.
So somebody's going, you know, from the sidelines to the market, but people are going from the market to the sidelines.
Right.
So we've got to be cautious on you know, how that is probably articulated, I think.
Right.
And so,
well, here's my, and look, it's a great point, right?
Yeah.
But here's my thing about this. It's really bad advice. And here's why this is bad advice. So she puts out this article. Look, a lot of people follow her, right?
Mm-hmm.
She has a huge following, and her following is way larger than mine. So I shouldn't say anything. I should just shut up and do what she does. But my issue is that you're telling people, go buy a 1-year CD at 5%. Okay, that's great. But what are you going to do after? Right? You get 5% for this year, then the Fed cuts rates. Then what are you going to do? Because now your CD is going to renew at 3%, 2%, 1%. It's going to go back to zero very quickly. The CDs are going to go back to where they came from because that's a big benefit to the bank, right? They get your money for nothing, and then they leverage it 10 times when they do fractional reserve banking, make business loans with it. They charge 5 or 6%. They capture the spread. So your CDs are going to go away very, very quickly. And so unless you're locking in a 30-year CD, your 5% is going to last for a year or two. But you can get that from a money market fund.
No, that's right. And that was kind of our discussion last night is that, listen, this is going to be great until it's not. And rates will come down. Now, do they get back to the 0%? I don't know. I kind of think in their conversation last night was that, hey, maybe it gets stuck around 3, which is something we've talked about. Which I could see that could happen. So, but regardless, you'll see rates at much lower prices. So the key here would be is that if you took this advice, which I don't think is bad advice, but it's not an all or nothing. This needs to be for, if you have short-term funds, obviously you want to keep funds that you need liquid. But if you say, hey, I've got something that I'm saving for the next year, I'm saving up for a home or a new vehicle, and it's going to be a year or two before I need these funds. Great. I think that's fantastic.
Yep.
Now, if you want to play the longer end of this, I think even better, because there's where your opportunity is going to be for actually locking in yield plus potential growth aspect to this. But you've got to be willing to do so and kind of know your risk tolerance overall. Right. And I think that's where.
Yeah, and I think that's the brilliant part of it. So of what you just said, which is really important. We talk about having emergency funds and having these type of savings programs. So hey, you want to? I got lots of emails from people like, oh, I'm trying to save up for a house. I want to take all my money and stick it in the market. No, because if you put the money you're going to use for a down payment on the house and the market goes down 20%, now you're really screwed because you're not going to get your house. Take that money, put it into a 5% CD. That's great, right? If you're saving up to buy a car, put that money in a CD. Awesome. Right? Anything that has a fixed finite date to it that's less than 5 years, put it in a CD because you can't afford the risk. And again, if you're trying to save it for something important, pay for your kids' college, whatever it is, right? And the market tanks 20 or 30%, 40%, which can happen. I'm not saying it will, but it can happen. It can really mess up your finances.
Oh, it can. That's a conversation we have frequently, especially with people trying to make up for lost time. Trying to get more aggressive and not understanding the time frame nor the risk that's there. In fact, it's funny, we talk about finances regularly in our household, and Michelle has a small business, and she's been saving money, and she said, hey, I've got X amount of money here, and I'm really excited for you to start investing it. And I was like, well, hold on. What's that money for? And we kind of went down that path. Mm-hmm. And so I explained the same thing to her, and she's extremely conservative by nature, but she's like, I'm really excited about this. I said, whoa, hang tight. And, explaining that, well, okay, what if it goes up by 10, 15%? Is that life-changing? She's like, well, going through our it's kind of funny. So going through what we're going through, if you follow along a little bit, our house flooded.
I forgot to get the house update.
Yeah, our house flooded. There's no update. Nothing has changed. We're in limbo waiting. We're playing the waiting game. But she did say, she goes, nope, but it gets me nicer bar stools. I said, fair enough. But I said, well, what if it goes down by 10%? And she's like, well, that's true. I was like, you'd be pretty upset about that. She's like, yeah. So I said, well, this is short-term money, so short-term money needs to be addressed as such. Either, find that money market that's paying 5%, which what she has, or you go and, lock it in if it is something that's going to be a little bit longer. And we could probably lock in for a year CD because I'm not real sure this is going to happen real quick with funds we may need here. But that's to the point is that you need to know exactly what these funds are for and stagger this out. Planning for this needs to be done and not just taking advice like this on a whim and just saying, oh, you know what? I'm going to go put everything in a 1-year CD or 2-year CD and be done, because I think you will regret it over time, especially if it's a longer term or a shorter term type of issue.
Yeah. And I don't know how it goes when you're budgeting, talking budgets in your house. My conversations go, well, honey, we're going to have to start cutting. All I hear is la, 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 la. As soon as I say cut, she's like, I can't hear you.
She's great. She keeps her own budget. She's shown me last night, here's what I spent this last month. And I was like, that's great. I appreciate it. And she's looking to where she can cut. And I'm like, I don't know where you can cut, but great. More power to you.
Too funny. All right. But I mean, look, I think CDs are a great idea. And, again, we've talked about before is, back in 2000 is a good example. Markets are rocketing higher. We're at all-time highs. And CDs at that point were paying 8%, believe it or not, back then. You get an 8% CD. And couldn't sell them, right? Could not sell a client on an 8% CD. Why? Because the market's making 10, 15% every year. I mean, we're just, rolling up. And it's like, why would I get an 8% CD? The market's just going up. Of course, that 5-year CD at 8% paid off gangbusters over the next 3-4 years as the market went through the dot-com crash. Same thing back in 2007, 2008. You couldn't get 8% CDs back then, but CDs paid well. So if you're banking on, and Danny made a great point, right? Marketed 22% last year. We're up 4% already this year. This isn't going to last forever, right? We're going to have a period like we had in 2022. I know you've already forgotten about 2022. Where the markets were down 19%, there are times that cash in a CD is great. And here's the other thing about investing. And I was talking about, I did a podcast yesterday with a guy, and he was talking about investing in the markets and this type of thing. I was like, you got to remember that investing is about opportunity, and where we go wrong is that as investors we start looking at the market and we just start chasing the market. Market's going higher, got to be in. But that's not investing. Investing is finding stuff that is really undervalued or gives you a really good opportunity of where it should be trading at on a fair price, and that you buy that asset for that appreciation over time. But see, we don't invest that way. And what a CD provides you a good opportunity to do is hold some cash and wait. While you're waiting for that opportunity to show up, you're getting paid 5% on your money. I'm all good with that.
Yeah. Now, I would be extremely cautious right now. Obviously, you want to make sure it's FDIC insured.
Yeah.
There's a lot of CDs out there. We scour for them for clients as well and kind of look at what's out there. But, what's going on with the regional banks that just happened, we've seen happening, but, it seems like it may have accelerated a little bit yesterday.
Right.
Some of the issues. So you want to make sure that, understand the bank that you're putting the funds with. Not that FDIC insurance is great, but what's the time frame for you to get your funds back if it is truly short-term needs? Mm-hmm. Typically, it's not bad, but something I would be considering right now. Not to say there's some big bank failure out there, but you never know what may happen.
Well, no, but it's interesting. We've talked about J.P. Morgan and we've made the Highlander comparison, which there can only be one. And every time somebody blows up, J.P. Morgan buys them.
Yep.
So in this midst of these small and regional banks getting shuttered down and regional and small community banks in particular are in a lot of trouble right now financially within the markets because of their exposure to certain things, flows, etc. J.P. Morgan has announced a plan today to aggressively expand their footprint of locations around the country. So
think about that. Everybody's shrinking,
but they're growing.
Yeah. It's going to be a
kind of
nationalized.
Like that BlackRock company you were hanging out with.
It's going to be a
night.
nationalized deal.
We're going to come back and talk about FAFO right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratcliffe will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
We sat down to watch the next episode of Reacher, and screen pops up and says, you're now going to experience ads during your show unless you want to pay an extra $2.95 a month. The mistake they're making is that all us old people, this is how we grew up with television.
The Real Investment Show podcast.
Always commercials. So, commercial in a television show, who cares? I'm not paying $2.95 to not have commercials. I don't care.
At realinvestmentadvice.com.
I get up and go to the bathroom during the commercial, come back, we're all good.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just a quick story. You're talking about your flooding. So my wife, is trying to get her house remodeled. It's been a standstill ever since late December.
Yep.
And she drives by.
So wait a second. Did you say her house?
Of course it's her house. Let me ask, where is your house?
I don't know.
Exactly. You don't have one. So she's been, she drives by her house and checks on it, right? Yep. And there's been nothing done, right? They're waiting to pour, it's like they have to pour the slab for the garage to build the garage, right? Nothing's been done. And it's been 3 or 4 weeks. So I've been emailing the contractor saying, hey, what's up? And he's not emailing me back. And so I emailed him about a week and a half ago. I said, I would advise you to give me an update as to what's going on because I'm going to refer this to my wife and you don't want to know that when I do. And he didn't respond to me. So I unleashed my wife yesterday, and guess what? We had a response by the afternoon.
Oh, yeah.
And everything is now back on track and will be completed on time by the deadline for her to move into her house. So, it's FAFO, man. Don't make me unleash my wife on you. So.
Yeah, I've been trying to delay that as long as possible because we are dealing, with the company that does kind of control, what you're going to get. And I'm like, ooh, we got to handle this a little bit more gentle than I think what you're going to be doing.
No, that's exactly me, right? I'm like more flies with honey, right? Yeah. I'm trying to be really nice, professional, all this, and but I have this armory behind me that just it's just
one woman armory, which is like 100 men.
It's like scorched earth, man. I'm just like, whew. Anyway,
nope, I'm right there with you. We're dealing with trying to navigate that and. They promised they're going to have numbers to us today.
Uh-huh.
I'm not holding my breath.
Yeah.
But same. If
If
we don't get something by
unleash the
3 o'clock
Kraken
today, if you're listening, be careful, bud.
No, don't mess. The tale of this story, or the moral of this story is don't mess with a woman's home. That is sacred ground, right? Most everything else she's really cool on. Don't mess with her house.
Well, I think Christina and Michelle are a lot.
Yeah, they're
similar
a
in
lot
of
alike.
ways in that they're both go getters. They want things done, and this just lull of not being able to do anything is killing her.
Yeah.
And the guy's like, you can't do anything on your own. You need to wait for me first. And I'm like, well, that's ridiculous.
Yeah.
It's my house. I want to put it back together and argue with you later. I should be able to.
Exactly. Anyway, all right, let's get back to work here. We got stuff to do. So we were talking about, this morning I was kind of hitting at some of these highlights that are kind of going on. We have this big divergence right now between, the economic headlines and what's happening with the average consumer. We're talking about consumer delinquencies on credit cards rising pretty sharply here. We're seeing tech layoffs starting to accelerate again. Quite a few companies are starting. Snap just reported a big plunge in revenue, so we'll probably see more layoffs from them. But we're seeing a lot more companies starting to lay off workers, and this is if the economy begins to slow down more, we're probably going to see those layoffs spread to other companies as well. Just right now we're seeing companies that kind of overstaffed a lot coming out of the pandemic, but a lot of companies ramped up hiring, and if things slow down enough, then you're going to get layoffs in other companies as well. But dealing with a layoff is difficult because it comes out of the blue, right? I mean, you're going to work every day, everything is fine, and all of a sudden, somebody says, "Can you go down to HR's office real quick? They need to talk to you," and you get this pink slip. Or how we do it in the financial industry is you walk in, there's a white box on your desk to pack your stuff.
There's no 2 weeks.
There's no 2 weeks. It's just you're done today. Thank you. But how should clients deal with that? I mean, what are some ways that advisors can work with clients to kind of ease that sting of the layoff?
Yeah, I think that right now, obviously, you're seeing more and more of this, and so I think it is more timely that we do talk more about this, and so. There's a lot of really good advice out there. There's also some poor advice as well. So the biggest thing I think people can do is once you are laid off, create that checklist. You need to create a to-do list. What do you need to get done and what is your time frame? And I think this is important that you do put some time constraints on this because number one, there are benefits that you could potentially lose out on. And so, one thing that I think that people overlooked, and I've seen some articles on this recently, and I haven't seen anybody touch on this, is understand your health insurance. And especially if you're closer to 65 or you're 65 and older, you need to get a very good understanding as far as what you should be doing. Do you take COBRA for a while and then get on Medicare if you're under 65 or you're 64, about to be 65? You need to make sure that you do switch from COBRA to Medicare because COBRA, while it does look like and feel like an extension of your employer plan, it is not considered a creditable plan for Medicare. So we have to be mindful of age and insurance. We need to understand what that looks like. If you have any group life insurance, is it portable? A lot of the times it is. Most people won't tell you that. You have to probably call HR and benefits, but that may be something, especially if you've since had something or an illness or been diagnosed with something. This could be a great way to continue to keep some life insurance at, you're going to pay a little bit more than what you've been paying because it's not subsidized any longer, but could be really beneficial. And so I always encourage people to look at that. I think that, stock options, a lot of times these options, they only have a 90-day window of when you have to exercise once you leave the company. So that may be something that a lot of people leave on the table. If you are an executive, you have those types of opportunities or those options that you've accumulated over years as bonuses or whatever it may be. Make sure that you have a very good understanding on that. Work with somebody to help you either move or unwind those, take advantage of that. Don't leave any money on the table. We see that quite a bit. And so those are just some small things. Now, obviously, that's where these timelines come in, that you have to have an understanding of what you should be doing, how you do it, especially going around, the healthcare benefits, because there are time constraints. And if you're over 65, you have an 8-month window once you get off your plan. So you need to be cautious and aware of that. But those are some really easy, low-hanging fruit. I think that, understanding, do you keep funds there in your 401k? Do you roll them over? What other type of plans do you have? What type of accessibility do you have to them? A lot of times you're encouraged to roll those funds over, but you may be able to make in-service distributions without a 10% penalty if you're under 59.5. So you may want to actually keep those funds in the 401k versus rolling them to the IRA, because you'll forfeit the ability to take earlier distributions without doing what we'd call a 72T. And at that point, there's a whole lot of additional information surrounding that. And so don't just jump and move those funds without understanding, how are you going to make ends meet? Do you have the emergency savings? Do you have funds readily available? Because if you're going to use the 401k funds to live on, you may not want to make that rollover, which is very counterintuitive to, I'm sure, what most of you guys have heard from financial advisors. We do typically, most people will want to roll those over because of, investment options, flexibility. If you go back to work, find another job, you have funds saved up, it shouldn't be a big deal. But if all of your assets are tied up in that 401k, which we know most people's retirement funds or their wealth is in the home and in the 401k retirement funds. So understand how you're going to make those ends meet and live. I think making a budget, having those expenses, getting a very defined, probably detailed list of what your expenses are and where can you cut. Right now is not a time to kind of keep things, hey, we're going to keep everything as normal. Unless you've just got a ton of money saved, great, but that's not the average American. And so, make sure you have a very good handle on the expenses. How can you make changes to help kind of soften that blow while you're looking for another job? Or maybe you're just going to retire and then, it's no big deal then at that point either. But these are just some small tips that I think would help a lot of people because, we are seeing more and more of layoffs. And I would suspect if we continue to see numbers and data like we're seeing right now, we'll probably see some more.
That's right. Real quick, we've got a couple of minutes before we close out. You were talking about rollovers and that type of thing. One area that we see rollovers for is, of course, retirement. And then, so you've got your IRA now. You've rolled it over into your IRA. Now you're 72, 73, 75, 79, wherever they're going to raise RMD requirement ages to eventually.
73 now. Yep.
73. So you've got to start taking RMDs. But what happens if if something happens to you, like you becoming incapacitated for a couple of years or whatever?
We've actually had some similar conversations with clients here recently in the sense of like, what should what are some basic things you should do to set up to protect yourself, protect a spouse? Number one, making sure you have beneficiaries on your IRAs. But, I think more importantly, if somebody becomes incapacitated and you can't make your RMDs, you want somebody to have some type of power of attorney to make those decisions on your behalf. So, make sure you have somebody that can work on your behalf to still make those RMDs, because if you don't, now, good news is it used to be a 50% penalty for the RMDs you did not take. So let's say your RMD is $10,000. You didn't take it. You still have to take it, pay taxes on it, and pay a 50% penalty. So you've completely eroded and just thrown money away, giving it to the Uncle Sam, right? So we don't want you to do that. Now, they've changed that where it's 25%. Now,
Still stings.
If you make it up within the next year, it is only now a 6% penalty, which is much better, and it still stinks there too. Yep. So having somebody and having all these things set up ahead of time. So number one, I would check with your advisor or your custodian, whoever houses your funds. Make sure that you do have beneficiaries set up on there. Understand, and it's something that I would update regularly. If somebody passes, do those funds actually go to their children? There's something called per stirpes, which we talked about yesterday with somebody, and they weren't aware of it. And, they had somebody pass, a loved one had some funds, and one of their beneficiaries had passed. Well, he didn't have per stirpes, so it doesn't just go to their descendants.
I think they have penicillin for that.
It's kind of funny because he actually said, "Is that per herpes? I never heard of that." It's like, no, hang on. But these are some things that are just housekeeping items. They have nothing to do with how you're investing your money, but everything to do with how you protect it, keep it, make sure you're not giving more to the government than you need to. So we talk a little bit more about that on the other side.
Sure. Basic financial planning. All right, be right back after the break. Don't go away. What's up with Yum Brands?
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So real quick, just kind of finishing up on this issue of becoming incapacitated, things to do. Look, this is, part of, if you have any money invested at all and have not taken the time to just do a basic will with some basic medical directives, do that. It will save your family a tremendous amount of problems that will occur if you haven't taken care of just some basic necessities of financial planning. And again, you can do a lot of this stuff online now. It doesn't have, if you don't have a lot of complicated, LLCs and a bunch of other stuff, you can kind of do a basic will and basic medical directives online for a very low cost. Just have something in place so that if you do become incapacitated, get hit by a bus, whatever, things happen, that your family isn't stuck, and then you're not giving up large chunks of your assets to the government because people can't act on your behalf.
No, and I think that's right. I mean, we've been doing this for long enough that you've seen a lot of this, unfortunately. And, you can go to Trust and Will. You can go to, what's the other one? LegalZoom?
LegalZoom.
Yeah, I mean, there's some easy places for you to take care of this. Now, I do prefer typically visiting with an attorney if you have something a little bit more complicated. And they do have attorneys on staff at a lot of these places. But somebody that's going to give you updates on a regular basis if you have a more sophisticated estate plan. And I do think that, having something in place, you certainly need just basic will, power of attorney, medical directives. I think that is going to cover the basis, right? Mm-hmm. But you also need to make sure the beneficiaries are updated, because a lot of people forget that beneficiaries supersede a will. And it's kind of funny. I visited with somebody the other day, and they were saying how this attorney told them to take all the stuff off and just say that it's going to go to the will. And I thought, well, how crazy is that? And I was thinking in my head, I was like, this attorney's kind of sly. Mm-hmm. He's trying to get them to have to go back to him so he can probate it.
Right.
It's like, what a crock. Yep. So this guy, I'm like, no, hold on now. So how are these funds going to go? Oh, they're going to go directly to the kids. I said, well, then why would we have that just say this is going to go to your will? Do you have anything specific in here? Let's look at this. You need to go back to that attorney and say, well, why would I not just put this on? I mean, we're not attorneys, so I don't want to give legal advice. Why would we not just put beneficiaries? Because the beneficiaries you have on your account will supersede the will.
Right.
So unless you have something within the will that creates a trust for the funds to pour over into, then you probably just want to put them directly on there and save yourself some time, money, and energy. And because if you do have those, all you would need is a death certificate, and then the beneficiaries would get the funds, versus having to go to the attorney, them having to go to the court and probate, which you may have to probate anyways, but this gives people access to funds much quicker. And so we see little stuff like that. But also I see a lot of times that they say, oh, we need a trust. Why do you need a trust? And so you kind of talk through it. And a lot of times these attorneys say, oh, yeah, you need one. Well, you may not technically need one. You need to understand why you would want to get one. And so just basic housekeeping, I think, can go a really long ways. And, like we were saying earlier, everybody, I think, is so consumed with talking about the markets and what's going up and down and our concerns with it. And obviously that's a big, big component of it. But, we forget to take care of the housekeeping items, which are, we should be able to check off and do it relatively easily. And you made a good point too, Lance, is that, get this done. It does. I think people, sometimes they see the price tag on it. It's like, whoa, it'll cost you a heck of a lot more if you don't do it.
Yeah, and we make it easy for you. If you go to our website, realinvestmentadvice.com, click on the investing tab, we've got a link right on our website for trust and wills. So you can click right through to them and start doing some of your basic kind of will planning needs, right? So it's a really easy process. They make it super easy for you as well. And if you need help, don't hesitate to reach out and send us an email, and I'll forward it to Danny, and Danny will take care of you personally.
You're funny.
He will. Trust me, he will. So real quick here, Yum Brands, and so it's interesting, Danny, because there's an article out in the Wall Street Journal this morning talking about why are Americans so down on a strong economy, and this is from the Wall Street Journal. The broad reasons for America's dim outlook suggest that even further improvement in the economy might not be enough to lift the nation's mood in an election year that is shaping up as one of the biggest impediments for President Biden to win a second term. He's received little credit so far for an economy that has foiled predictions of recession and instead grew at 3.1% last year, far ahead of the pace. By some metrics, that improvement is starting to give way to views of the economy. Consumer sentiment's ticked up, employment remains strong, so forth and so on. So if the economy's doing so well, why are people so down on the economy? And I thought this was interesting because Yum Brands, which is part of, it's YUM is the symbol for the company. It was a spinoff from Pepsi a while back. But Yum Brands is the company that owns Kentucky Fried Chicken, Pizza Hut, and Taco Bell. And by the way, Pizza Hut has now a new pizza offering out in 3 cities. It's called the Breakup. It's called the Breakup Pizza.
This is for Valentine's Day?
Yeah. So you send it to the person you want to break up with, and the box says goodbye on it, and you has a spot for your name. And so you can just send them a breakup pizza.
Is it in the shape of like half a heart?
I'm not sure. But they, in 3 cities, they're offering a breakup pizza. So goodbye. There's your pizza. Anyway, it was interesting in the report because on Wednesday, Yum Brands reported quarterly earnings and revenue that missed analyst expectations. Expectations as KFC, Taco Bell, and Pizza Hut all reported weaker than expected sales. And this goes back to what we were talking about earlier, Danny, about credit card delinquency rates going up. I just went and looked up so if you've got a family of 4, right? Mm-hmm. You go to Kentucky Fried Chicken, you pick up a 16-piece bucket of chicken, right? It's $32 for the chicken.
For a 16-piece bucket of chicken. Okay.
So just do it. Okay. So let's say that you're going to do, and again, remember that's mostly, legs and thighs and a couple of breasts, right? So, a lot of dark meat, a little bit of white meat. 12 pieces run $25. So you just think about the cost of eating out has gone up so much. And then of course, this doesn't include now, because everywhere you go, no matter what it is, somebody wants a 25% tip, right? On top of it, even though you did all the work of ordering and bussing your own table and doing everything else, the cost of eating out has just gotten so expensive. So I think it's just kind of an anecdotal point is that, the economy seems really strong, but if you think about Yum Brands, right? So that's Pizza Hut, Kentucky Fried Chicken, and Taco Bell. These are your kind of your lower rung fast food chains. If you want to pay more and have better quality food, you go to Chipotle, right? Which is a higher end.
That's $20 a person.
Yes. It's very expensive, right? But that's a higher end fast food. So that's what I'm saying. So if you just kind of look at, if you say, okay, well, where's the average American likely to go get fast food? It's going to be McDonald's, which just reported weaker than expected sales. Mm-hmm. It's going to be Kentucky Fried Chicken. It's going to be Taco Bell. It's going to be that realm of of restaurants, fast food restaurants. And I just think it's interesting that they're all Starbucks, right? Also reported weaker than expected sales, which now you're taking away people's caffeine addiction. So if people are starting to shop less, I think that tells you more about the state of, the average American and why they're so frustrated with the economy, because all these numbers sound great, but they're having a tougher time making ends meet. And now that's showing up in the earnings of these companies, which, by the way, these companies are missing estimates that were drastically lowered before they even reported estimates. So the reality is, if we went back with the original estimates for Yum, this miss was much deeper than what's actually reported.
Yeah. So what do you think that's? I mean, obviously money, but do you think that's?
Yeah, it's a cost of living's going up a whole lot more than people's wages.
Well, but is it also maybe a byproduct of the policies that are in place where, we're seeing higher minimum wage? I mean, we've always talked about how these jobs were intended for somebody to just get their feet wet. It'd be the first job that they have, or, you're getting, something for a short period of time, and then you work your way up and you work your way to management, or you work your way further up the line. And
but
that's not what's happening now, right? Everybody just thinks that they're required a certain wage.
No, when you raise minimum, when you force companies through political actions or whatever to raise minimum wages, California, good example, right? 22-hour minimum wage. Restaurants are leaving California because they can't afford to operate there. A McDonald's franchise has now gone up $250,000 in California to compensate for the $22 hour minimum wage. So people that may have been able to afford the $750,000 for a franchise, now it's $1.25 million for a franchise in California to compensate for those wages. So look, any action that you take that raises the cost of operating a business, that doesn't evaporate into thin air. It gets passed on to the consumer.
Yeah, correct.
Right. That's why, even though
that's why people are so upset. They're like, wait a second, now I've got a hamburger that's $15.
Right, and that's why we see the inflation rate coming down, because the cost of a hamburger a year ago was $15. It's now $15, right? So there's no inflation, but it's still twice as much as it was 5 years ago, right? Look, I remember growing up. I remember raising my kids. I could take all 4 of my kids to McDonald's. This was a decade ago, and I could feed them all Happy Meals for like $20. I could get out of there. It's like $50 now, right? So it's not. It's all these things that we want to do that raises the cost of service has to be passed on to the consumer, because that's how companies protect their profit margins, right?
Yeah, but the problem is that we haven't seen wage growth in the other part of the demographic increase as much as what we've seen for the lower end, right?
Exactly, and then you get anomalies to these wage growth statistics, like it says wages are going up, but really they're not, because we're cutting the number of hours you're working. So that's a mathematical anomaly that says, oh, you're actually making more money because you're working less hours. No, you're working less hours, and if you're paid by the hour, guess what? You're making less money.
That's right.
So anyway, that wraps up the show for the day. Be back tomorrow with Michael Leibowitz. Had a lot of Fed speakers this week. We got 2 more today. So we'll get with Mike tomorrow. What have they all been saying? What does it all mean? And again, this whole big debate between markets and the Fed on who's going to cut rates more. We'll see. Talk about that with Michael Leibowitz tomorrow, of course, on the show. Have a great day. Get by the website. If you need trust, will planning, etc., go to realinvestmentadvice.com, click on the investing tab, and there's a link right on the homepage for trust and wills. Take care of that today. It's good for you, like spinach. See you back here tomorrow.